Happy morning, people. So yes, so let's continue our marathon discussion further. So today the topic that we're going to be taking up first is Accounting Standard 10 that talks about property, plant and equipment. It is that earlier we used to call it as fixed assets. Instead of fixed asset, now the name has been revised and made as property, plant and equipment, or in short form mein PPE. So AS10 gives the complete guidance as to how this property, plant and equipment should be valued, disclosed, etc, etc, etc. Right? So let's dive into the first component. One, sir, this Accounting Standard 10 is not applicable for few assets. One, it is not applicable for something called biological assets. Biological assets means living plants and animals. The living plants and animals we refer to as biological assets. AS10 does not account for it. In Inter, you don't have any accounting standard for it. But in CA final, we have Ind AS 41 called agriculture. That talks about accounting of biological assets. Since there is an other standard giving treatment for this, Accounting Standard 10 kind of takes a back seat. So it does not cover them. Okay. All right. Another one is exploration assets, like your coal mine, gold mine, mineral ores, like these. If you have, we call it as exploration assets. We have Ind AS 106 for it in CA final, right? Since we have another standard for it, again, these are excluded. So these are the exclusions. They are not that important, but since we have an MCQ in our pattern, even these things also can be considered. Okay, for framing the question. Now, if you want to call a component an asset as a PP, if you want to call a component as a PP, there are three definition criteria which should be satisfied. One, it should be a tangible asset. It should be a tangible asset. Tangible means you should be able to touch, see and feel. That is one. Second one, it should be held for use. That PP should be used for something, and usage could be one of the four purposes. Either to produce goods or render a service or administrative purpose or rental purpose. For one of these four purposes, you have to use that PP. Producing goods is pretty much straightforward. You will use, factory is used to produce goods. Like here, ArivuPro, we are using app to give you recorded classes or some service or track your attendance, etc, etc. So PP should be used either to produce a goods or to give some service or for administrative purpose. Administrative purpose means, sir, there are many property, plant and equipment or fixed assets which cannot be directly used for production. Like ArivuPro, if you think about it, we have AC in reception. We have AC in the reception area, lobby area. Are classes being conducted there? No. That means, is that particular AC used to provide any service? No. But still, are they necessary? Yes. So that comes under which category? Administrative. So even if you are using a fixed asset for administrative purpose, it is acceptable. Okay. The last one is rental purpose. You can rent that plant and machinery or fixed asset to somebody else and earn some rental income. For one of these four purposes, compulsorily it should be utilized. Is that okay? And that usage should be for more than 1 year, as in 12 months. So again, what are the three components? One, it should be a tangible asset, meaning you should be able to see, touch or feel. You should be held for use. The usage could be either to produce goods or render service or admin purpose or rental purpose. And that usage of property, plant and equipment should go beyond 1 year. Okay. So if these three are satisfied, then an asset comes under the definition of what? PP. It comes under the definition of PP. But if you want to show that PP in balance sheet, there are two more recognition criteria. There are two more recognition criteria which we used to call it as FEB and cost measurement. FEB and cost measurement, meaning FEB as in future economic benefit. Future economic benefit, meaning from that property, plant and equipment, you should be able to get some benefit. Now, why do you think we have purchased iPad? Why do you think we have purchased this iPad or laptop and all? So that we can give some service and we can earn some money from that service. So from that PP, you should be able to get some benefit. It's not necessary that you should get the benefit immediately. If the company feels they will get the benefit after 1 year, after 2 years, after 6 months, that is also fine. As long as there is a benefit expected either currently or in future, it is acceptable. Okay, Ji. So this is the one of the recognition criteria called FEB. Don't use short forms and all in exams. These are just for the remembrance sake. Another one is cost measurement. How much money we spent for that PPE, you should be able to measure it. So basically, if PPE has to appear in balance sheet, how many criteria should be satisfied? 5. 3 definition criteria, 2 recognition criteria. So all the 5 are satisfied means PPE will appear in your balance sheet. Otherwise, how much ever you have spent will be transferred to P&L. If these criteria are not satisfied, how much ever amount you have spent will be straight away transferred to P&L account. That way. Are we okay with this? Alright, coming back to the next one. As I said, biological assets means living plants and animals. Okay. But there is one small exception to this. First of all, go one step back. For biological asset, AS10 is applicable or not applicable? Not applicable. And biological assets means what? Living plants and animals. But there is one exception to this biological asset called bearer plant. Called a bearer plant. Meaning exception of an exception is applicability. Exception of an exception is applicability. Like maths we say, negative ka negative when you multiply it becomes positive. Na? Here also same drama. Exception of an exception becomes applicability. Meaning for bearer plant, AS10 is applicable. For other plants and other animals, not applicable. Is that okay with you? Okay. That means we need to know what is meant by now bearer plant. If you remember our regular class, I used to give mango tree example. Okay, or in simple terms, I'll probably, in the interest of time, I'll quickly tell you. First, maybe I'll call out the condition for you. If at all you want to call a plant as a bearer plant, 3 conditions should be satisfied. All the 3 conditions should be satisfied. One, that plant should be used in the production or supply of agricultural produce. It must bear the produce for more than 12 months. It has remote likelihood of being sold as agricultural produce except for incidental scrap sales. That is the exact criteria. You don't have to mug up all this. If you know it, awesome. But what usually gets asked in examination is, at best, these are not too much targeted. They may give you some criteria and they may say whether it is a bearer plant or not a bearer plant. You may have to just identify. But if you can remember, it's good. Why do I say that? Accounting standard 10 at CA intermediate, Ind AS 16 at CA final, ditto. Not even 1% change. This standard, if you learn properly, next topic of CA final, you are covered. Except that few questions are not tested at CA intermediate level. Few big questions are tested at final level. But conceptually, you will not learn anything extra. Maybe 1 or 2 extra at best. So that way, it's good to know is what I feel. But rest, I'll leave it to you. Okay, Naji. Now coming back, bearer plant. What is the first criteria I said? It must be used in the production or supply of agricultural produce. Common sense, sir. From that plant, you should get agricultural produce. From that bearer plant, you should get agricultural produce. Now let's see if mango tree can be called as a bearer plant. Can a mango tree be considered as a bearer plant? From mango tree, you will get apple. What will you get? Mango. Mango is factory produce or agri produce? That means first criteria failed or passed? Passed. Because you are getting an agri produce called mango. Second one, it should bear the produce for more than 12 months. Meaning from the tree, you should get produce not just for 12 months, but for more than 12 months. Because PPE means you will use it for less than 1 year or more than 1 year. More than 1 year. Now, if you want to consider bearer plant as a PPE, then that you should get mangoes for less than 1 year or more than 1 year. More than 1 year. If that mango tree gives you mangoes for more than 1 year, then we say second criteria is satisfied. Understood? Third one is what? Basically, now if there is a farmer is growing, is upkeeping the mango tree, let's say. What do you think farmer ka business is here? He will sell the mango tree or he will protect the mango tree? He will try to protect the mango tree and sell only what? Mangoes, correct? But suppose there is another farmer. You know what his job is? He'll put mango seeds. Once mango tree comes into picture and mangoes are extracted, farmer does 2 things. You know what he does? He collects the mangoes. After all the mangoes are collected, he will cut the mango tree and sell it to the wood industry, because for furniture and all you need wood, no? So his business every year is this: sell mangoes, cut mango tree and sell mango tree also. That means he's selling 2 things normally. What are those? Mangoes and mango tree. That should not be done. Because now do you think ArivuPro will sell its iPad every year? No. Only if iPad starts acting weird, if it is not performing properly, then only we will sell. Meaning you should only sell it as what sale? Scrap sale. Regularly you should not sell the tree. Regularly if you are selling the tree, sorry boss, it is not bearer plant, it becomes your inventory. What you sell regularly is not property, plant and equipment, that is your inventory. These are the three conditions that they are talking about. Manageable. Tell me once again, what are those? If you want to call it as bearer plant, from that plant you should get agri produce. And you should get that produce for less than 1 year or more than 1 year? More than 1 year. Third one, the tree should be regularly sold or only as a scrap sale? Only as a scrap sale. If these three are satisfied, then a plant becomes bearer plant. Usually mango tree, apple tree and all will satisfy this criteria. So it comes under which category? Bearer plant. And if it is bearer plant, AS10 does not apply or it will apply. It will apply. Move on to the next. Okay, RC we have already seen as in recognition criteria. Okay, next one is spare parts and standby equipments. Now people, we have inverters and generators. Every office will have either an inverter or they will have some generator. Will we use it daily? Will we use the inverters and generators daily or only in emergency case? Matlab, when there is a power cut, only then we will use inverters, right? They are all known as what, sir? Standby equipment. Now we are trying to test, can we consider standby equipment as a PP? Can we treat standby equipment as a PP? AS10 says yes, standby equipments are also can be considered as PP provided conditions are satisfied. 3 definition criteria and 2 RC criteria. Usually they say if recognition criteria is satisfied, then you can show it as PP. If it fails, show it as inventory. That's all it is. There's a classification recommended for spare parts as well as standby equipment. Spare parts means, now you know, I'll give you our own example. Now this pen is there now. This pen is there. Now pen is, it will come for a long time. But no, many faculty will be in Josh. Passionate. Suddenly tupuk, it fell off. My hand went, it fell off. It has happened. No, it has not happened. Yeah, they'll put tax on me, no. Alright. So this nib, no, sir, it's quite sensitive. Nib is quite sensitive. Maybe if there is a hard drop, if it falls from a big distance, do you think that nib will work properly or go in the? So we have kept some spare parts as nib. We have kept some extra nibs. So when this gets damaged, we will throw the pen or we'll only replace this. That becomes what? Spare parts. Okay, like this, many organizations, no, when there are some big assets and all, they will like to keep some spare parts so that the business should not get affected. Criteria for that is also same. If RC is satisfied, meaning definition and RC is satisfied, then you will classify it as what? PP. Otherwise, classification will become inventory. That's all about this. Move on. So far, okay. All right. Okay. Next, replacement of parts. So if you replace one part, okay, you're not selling the whole asset. But a part of the asset is getting replaced. In that case, what we'll have to do? If you remember our regular class, I used to give you this electric car example. Okay, but anyways, I'll take you through the same example once again. Let us say I have purchased electric bandi. Life how much? 10 years. How much cost? 15 lakh. So I paid 15 lakh and I purchased an electric car. I am expecting this car to last for how many years? 10 years. But that vendor from whom I purchased, he told, boss, car is super. Car is amazing. Good choice. But battery you have to replace every 5 years. Battery you'll have to change every 5 years. I asked how much battery? He told 5 lakh will be a battery cost. Because electric car ka big cost is towards battery. So out of 15 lakh that I have paid now, how much is for the battery? 5 lakh. That means how much is for the others? All other parts, so like steering, wheels, major engine and all will come for how many years? 10 years. But battery alone, I have to replace after. Is that okay with you? Possible, no? This can happen. Now, okay, I said no problem. Give me the car, we will make the deal. So I paid the money, got the car. But look at my vastu. After 3 years only, battery dumber. After 3 years only, battery gone. It stopped working. Sir, I was expecting the battery to go for how many years? 5 years. But depending on our Bengaluru, Chennai road condition, okay, potholes, so things like that, that battery lasted only for how many years? 5. I think Chennai is better. Bangalore, only. Okay, most of the time we'll be driving on footpath only. Because so much of potholes and so much of traffic, people are finding like squeezing in everywhere. Comparatively, I found Chennai ka traffic to be better. I've not roamed around too much, but wherever I have roamed around, I feel this is more peaceful. Okay, but anyways, okay, now coming back to the example. At the end of year 3, what happened? Battery gone. Now what I have to do, sir? At the end of 3rd year, what I'll have to do? I have to replace, I have to buy a new battery. Now, two questionable things have come into picture here. One, you are buying new battery, right? When? End of year 3 or beginning of year 4. Now, first question is, what should we do for new battery cost purchased? Let's say I spent about 5 lakh rupees more to buy a new battery. What should I do for that 5 lakh? Should I add it to the cost of PPE, that is electric car, or that new battery ka 5 lakh cost I should transfer it to P&L? Did we understand? The new battery cost I should capitalize and add it to the cost of PPE, or should I transfer it to P&L? Question number 1. Second question, what should I do for the old battery? What should I do for the old battery? Are you getting the 2 points over here? So these are the 2 points which accounting standard 10 is trying to address. Okay, that concept only we're calling it as what, sir? Replacement of parts. Okay, Ji. So if I have to tell the provision in one liner, what accounting standard 10 is saying is, if you are replacing any major part, then you just check if RC is satisfied. If that new part satisfies RC. What is RC? Feb and cost measurement. If that new battery satisfies recognition criteria of future economic benefits and cost measurement. If the new part satisfies RC, then the new part ka cost you capitalize. Meaning don't transfer it to P&L, but rather add it to the cost of PP. This is okay. And standard also says, is the old battery there or gone, Govinda? Is the old battery there or gone? Gone. Sir, in car you will fit 2 batteries. No, when old battery is gone, you will remove the old battery physically and replace it with what? New battery. That means in that car, old battery is physically present or taken away? Taken away. Yes, you removed it. So physically, if you are removing old part, books also it should be removed. That's what standard says. Carrying amount of old part, if at all, if it is remaining, remove or derecognize. So 2 components. What are those? What are the things I said? New part ka cost you add, provided RC is satisfied. Old part ka carrying amount you remove. So one addition, one subtraction. That's all we'll have to do. Sir, how will old part have carrying amount, sir? Okay, look at this. Let's work it out through this. Sir, how much did I spend for buying a car? 15 lakh. In this 15 lakh, how much is towards battery? 5 lakh. How much is towards other part? 10 lakh. Correct? Huh? Now, battery, I thought when I purchased, it will last for how many years? 5 years. Others, I thought will last for how many years? 10 years. What standard says here is, sir, normally till now, we used to calculate depreciation on what amount? Till now in our 11th grade and all, we used to calculate depreciation on the total amount. But AS says, accounting standard 10 says, if different parts have different life, calculate depreciation separately. Don't calculate depreciation on 15 lakh. Calculate depreciation on 5 lakh separately, 10 lakh separately. Why, sir? Because these two ka life same or different? This is okay with you? This we, in standard terminology, we call it as component accounting. It's not tested too much at your level, but just saying for your reference, it's called as component accounting, meaning different components, meaning different parts have different life. Then depreciation also should be calculated separately. Okay, Naji? Now let's calculate the depreciation. Straight line depre ka formula chapandipa. What is straight line method ka formula? cost to, or I used to, I think I clarified that in my class. It is not cost, it is actually carrying amount. But anyways, no problem. Tell me. Cost or carrying amount minus residual value divided by life. Okay, let's calculate this. Okay, sir, when in my example, when are you replacing the old battery? Third year ending. So 3 years you have used old battery. So let's calculate depreciation for old battery for how many years? 3 years. Calculate how much is the battery car carrying amount or original cost? 5 lakh. Minus what? Residual value. Have I given you any residual value? No. Not given means it is 0. Divided by life. What was the total life expected initially? 5. So divided by 5. If you do this, what are you going to get? If you do this, you will get depre for 1 year. You will get depre for 1 year. I have used the old battery for 1 year or 3 years. So if you want 3 years ka depreciation, multiply by 3. How much you going to get? 3 lakh. So initially I paid for the old battery how much money? 5 lakh. How much has got depreciated? 3 lakh. How much is still remaining? 2 lakh. This we call it as carrying amount remaining of the old part. Carrying amount remaining of the. This is what we should do. Can we still show it or derecognize? This you'll have to minus. This we'll have to. And new battery ka cost. New battery ka cost. Let's say new battery ka cost is 7 lakh. Inflation, no. 5 years back it was 5 lakh means as the years progress, the value of the price of the product will increase. Let's say the new battery ka cost is how much? 7 lakh. What will you do for this? New part ka cost you will add, old part ka carrying amount you will deal. Suppose if this has become 0, suppose this has become 0, then should we have to do any adjustment or not required? No. Yes, no. Sir, when will it become 0, sir? Suppose battery lasted, old battery lasted for 5 full years. Old battery came for how many full years? 5 full years. Now calculate depre. 5 lakh original cost minus residual value 0 divided by life was how much? 5 years. I used it for how many years? 5 years. I mean, this will be 3 lakh or 5 lakh. I mean, this will become what? In that case, may should I have to do anything? No. That's all it is. Okay, now people, if at all any carrying amount of old part, if it is remaining, remove it. Because physically that battery, something happened. Or maybe it got timed out. I think. No problem. Now it's okay. We'll send Christopher away. Enough. We will concentrate on this. So, okay now people. So that's all is the funda. Sir, same concept holds good for what? Major inspection also. This replacement concept and major inspection concept are same. So what is that whole concept again? New inspection charges you add. Carrying amount of old inspection you minus. Sir, what is this inspection, sir? Some major assets, no, like aircraft, so ship and all, no? Especially aircrafts and all, right? Now you are taking people from one location to another. Sir, safety is very, very important, no? Now if you say, like, no, I will not check the safety and all. Anyway, India's population is too much, no? Big deal if 200 people, Swarga means okay, Kailasa means okay, no? Can we approach business that way? No. So usually what government will tell is, if you are in that industry, you'll have to do a thorough inspection of your aircraft because you are playing with people's life. So all this will not be small amount. All this amount will be on the bigger side, crores together. Every nook and corner, every nut to bolt and all will get inspected. Thorough inspection you should do. Maybe once in 3 years, 5 years, you'll have to do it. Okay. So hence, this will not be your small expenditure. It will be a large expenditure. So the concept of the replacement part and major inspections are pretty much the same. Wait, carry on. Carry on, pakana. It usually inspections will not have carrying amount unless your aircraft met with a sudden accident. Then the government may tell you, initially government would have told get the inspection every 5 years. The aviation ministry would have told to get your aircraft inspected every 5 years. Third year, no, you sent 100 people to Kailasa into Bay of Bengal, your aircraft. Now what do you think government will do? Check all your inspections, check all your aircrafts. When? Third year. So in that case, old inspection charges might have a carrying amount, but usually it will not have. But if at all it is there, same concept. Okay, moving on to the next one. Sir, initially I have to show PPE at what value in my ledger? I should pass the journal entry for PPE for what amount? That is this concept. That we call it as initial recognition of PPE. 3 things you should keep in mind for initial recognition. as a thumb rule or as a basic rule, initially every property, plant and equipment, doesn't matter whether it is furniture, machinery, aircraft, ship, whatever, every property, plant and equipment or every fixed asset will get recognized at cost. Every asset will get recognized at cost. Cost for this purpose can be categorized into three things. Okay, one is your purchase cost, another one is your DAC, another one is your DSR. These are all short forms we used to use in our class. I'll tell you in case you're not comfortable with those terminologies. Okay, what did I say? Initially, all PPEs are recorded at cost. Cost for this purpose will include three things. One is what, sir? Purchase cost. Sir, if purchase cost is a major part of cost, if you want to show PPE, first you have to purchase it. So this is self-explanatory, yes or no? Purchase cost will form part of cost. That is one. Now, when you purchase a fixed asset, Nirmala Sitharaman ji will come into picture and say, give me GST, give me tax. So correct, a customs duty, GST, many things will get attracted depending on how you are buying it, where you are buying it. Yes, sir. Now, what should we do for that tax? We have paid. Should we add that tax to the cost of PP or should we exclude it? You got the question? So what AS10 says is, if it is a non-refundable taxes, meaning if you don't have input credit, if you can't claim input credit, then only you can add. If you are able to claim the credit, don't add. That only they're calling it as what's a non-refundable taxes. Meaning, or another, if you forgotten tax soup, on one hand I am paying GST, on another hand I am collecting that GST back. On one hand I am paying, on another hand I am collecting. That becomes refundable taxes. That you cannot add. I just paid, like when you buy a mobile, you pay only for the mobile or you pay GST also? You pay GST also. Did you get it back? You got mobile, did you get your GST amount back? That means for you, the GST is what? Non-refundable tax, because you paid, but did you get back? So such non-refundable taxes you can add. Refundable taxes you cannot add because common sense. Is it really an amount or you got it back? When you get it back, you can't add it to the cost of PP. That is not acceptable. Okay, Naji? If you have any rebates or trade discounts, sometimes when you buy in bulk quantities, suppose for one mobile, the cost is 50,000. For one mobile, purchase cost is 50,000. You told I will buy 100. You told you will buy 100. Now, what is the first thing you will ask? Hey, macha, give me discount, no? For 150,000 means for 100, it should not be 50. It should be lower. That discount, we call it as what, sir? Trade discount. If at all that is there, means reduce it. When you do this, you will get the net purchase cost. By doing this, you will get the net purchase cost. That is the first category of cost for people. Sir, all this concept straight away gets tested. This is one of the popular question from which turns up, has come in. Meaning they will not ask the concept. They will give you some expenditures and then they will say, can you add this as cost or will you include, exclude, or what you'll do? That is a popular question. So unless you know the concept, you will not be able to proceed further. So pay attention to the provisions, because provisions are the main thing. If you know the provisions, any sort of questions they ask, somehow you will be able to tackle. Okay, Naji? Okay, this is done now. Next is what? DAC. DAC is a short form. DAC simply means directly attributable cost. For class purpose, we used to call it as DAC. DAC simply means, sir, suppose now, excuse me. Now, if I buy a furniture, let's say I purchased a furniture for Bengaluru. My office is in Chennai. I purchased a furniture from Bengaluru. Why, sir? My choice. Don't ask why again. My example, my choice. Okay. So my office is in Chennai, Nungambakam. Okay, but I purchased a furniture from Bengaluru and I paid 1 lakh for that furniture. Okay. But right now furniture is where? Bengaluru. From Bengaluru, if it has to reach to Chennai, I'll have to pay transportation charges, right? So all that comes under the DAC category. All that transportation charges, installation charges, assembly charges, testing charges, blah, 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 everything will come under what, sir? DAC. Because you can incur 101 charges, no? To get the asset from Bengaluru to Chennai, I can incur so much of expenditures. Standard will not go line by line item and say this expenditure you can add, this expenditure you should ignore. Like that, they will not go it. But they will simply say, okay, they will simply tell one term. They will use one provision. That provision will tell whether you can add it or not. Okay, again it went off. Frequently it is going. I'll have to ask them to change. Okay, that terminology here is what, sir? DAC, directly attributable cost. What is the meaning of this? Is simply this. Standard is saying till the time asset is management ready. What am I saying? Till the time that asset, that PP is management ready. Whatever cost you are incurring on that PP, add. Till the time that asset is what ready? Management ready. Whatever cost you have incurred on that particular PP, you can add. Related cost, not every damn thing. Okay. Now, my office is where? Chennai. I will use the furniture where? Chennai. Right? Unless I pay transportation cost, can I use it? Can I use the furniture without incurring transportation cost? No. So is my transportation cost necessary to make furniture ready to use? Yes. That means it becomes what, sir? DAC. Can you add it? Yes. Now furniture will be sent just like that, or it will come in part by part. If it's a big furniture, it will take a lot of space. So usually the vendor will send it in part by part. Correct? No. Then what I have to do? I have to assemble them. I have to make sure that all the parts are assembled and it becomes a furniture. For assembly, I may have to pay some charges. Unless I assemble, can I use it? Will it become management ready? No. I mean, assembly charges also is an example of what? DAC. This only in your earlier grade, you have studied, no? Transportation charges or installation charges, or etc. etc. But AS using a fancy terminology called what, sir? DAC. They are all examples of DAC. Okay, Naji? Comfortable, Naji? Okay. No. Let me see how well you have understood. I have a receptionist salary. Salary. Can I add receptionist salary in my furniture example to furniture? Receptionist ka salary. Let's say furniture from Bengaluru to Chennai. For that furniture to come from Bengaluru to Chennai, it took about 1 month. It's a customized furniture. Let's say I told the vendor I need rosewood furniture. I don't want normal furniture. I need or sandalwood. Crazy. Okay. Sandalwood furniture I need, I said. Okay. Furniture only, macha. Not pushpa. He's going to pushpa mode only. Okay. Right. Furniture to use only, not to sell, not smuggling. Normal. I am pakka legal businessman. Okay. Just to use that only. I said I need a sandalwood. I like the smell of sandalwood. I told make sandalwood furniture for me. Okay. But for that it will take how many months? 1 month. So I said 1 month ka receptionist salary I will add to furniture. That 1 month ka receptionist salary I will add to furniture. Can I do that? No. Why? It is, see, the key word there is not cost. The key word there is what? Directly attributable cost. Is receptionist anyway linkable? Receptionist salary linked to furniture or not linked? Whether receptionist comes to office or it does not come to office, furniture will come. Yes or no? So is it a related cost or not a related cost? Only related cost is an example of DAC, not every cost. Okay, Naji? Again, my screen went off. Noda, what is happening here? Da? For you, it's there. So can I trust you and go? Na? Okay, but if I press this again, Christopher will come and you don't want to see Christopher, no? I pressed escape, it's not working. I don't know why. I am getting a little bit buku, whether recording is happening or not. Hey, for me, nothing. Hey, call someone, Father. I think someone just call some person out there. Here it went off only. Yeah, early morning was not good. Maybe pakka this today 3:30, 4 o'clock. You sit and do, sir. We will go. Huh? Screen is getting timed out frequently. Okay. Now, once I would like to see if the recording is happening so that I'll have that mental satisfaction.
Sure. 1 minute. It's a date, just give me.
Okay, so what should I do? I'll have to reconnect this every time?
No, sir. I'll just call me, sir. That is a little bit a technical issue here.
Okay.
Now
So Because it happened like 3 to 4 times. Yeah. So if possible, maybe ask someone and try to replace that particular cable if that is the case. Thank you so much. Yes, people, where were we? We were in Sandalwood. Yeah, I know. Okay, so that example, are we comfortable? So we looked at, there are how many categories of cost? The net purchase cost. Another one, DAC. Another one, DSR. DSR ka full form is decommissioning and site restoration cost. This one, is a big concept. Usually it gets tested at final level. It's not tested too much at inter level. I'll just tell you the meaning of it. And one liner, they may test you at best. Major calculation, I feel, may not be tested as my feeler, but I might be wrong. ICI is known to make you feel wrong. We thought it will never come, but sometimes some attempt might come off. It has happened, but anyways, I'll just give the glimpse of it regular class I have given you, explain this with the journal entry. Now I'll just tell you just in one liner what you need to do. Decommissioning and site restoration cost. What is this? Is simple, sir. Same example I will give you. Reliance. Most of us are using a Jio Dhan phone. At least connection. Okay, let's say now, sir, for Reliance to operate that mobile network, they need telecom towers. Have you seen those telecom towers? Right? Now, telecom towers will be placed next to road. Will they place it next to road? No. They'll usually install that telecom tower on a high-rise building. In one building, big building, usually they'll install that telecom tower. Now, Reliance approached one building, let's say this building only, and they said, we will install telecom tower here. Okay. A building owner said, no problem, install. Anyway, mobile connection is not good. At least that way I will get a better connection, so do it. Building owner gave permission. The building owner got curious and asked, for how long will you use this tower for? Reliance told 5 years. How many years? 5 years. Building owner asked, after 5 years, what will happen? They told that telecom tower, I will dismantle. I will remove it, take it away. Okay. Building owner asked, any damage to building? Reliance told, of course. Of course. Just 10 lakhs. Only 10 lakhs repair cost will come. When? No? After 5 years. Now, what do you think building owner will say? Hey, macha, come. My building is proper. You told you will put in one tower. And then you are saying after 5 years, you are putting me how much chuna? 10 lakhs. Repair cost will come. Yes or no? What do you think building owner will tell? Building owner will tell the Reliance people, you repair that. You repair it because my building was proper. It was only getting damaged due to your tower installation. Yes or no? And the building owner will say the Reliance, you repair that cost. Suppose Reliance says, no, I will not. What do you think building owner will say? Oda day. I will not give you permission to install the telecom tower. Yes. That means for the Reliance, telecom tower is a PP. For the Reliance, telecom tower is a PP because it is lasting for how many years? More than 1 year. Definition and RC is getting satisfied. To use this telecom tower, is this repair cost necessary or not necessary? For the management to use this telecom tower, repair cost is, that means it is what? DAC. It is what? Direct cost is what we call it as what? DAC. Yes, sir. That means we can call it as DAC only now, sir. Why are we calling it as DSR? Why they have created a separate provision for this is, sir, normally installation charges, transportation cost and all will come in the future or immediately. The installation charges, assembly charges and all will come immediately. This is coming immediately or after 5 years? After 5 years. And how much after 5 years? 10 lakh. Sir, 10 lakh after 5 years, is it same as 10 lakh now? If I give you two options, take 10 lakh now, take 10 lakh after 5 years, you will be Brahaspati and say, give me after 5 years. What will you tell? Give me now only, yes or no? Because there is a concept of present value, future value. Yes or no? So hence, since this cost is coming in future, they have given a separate terminology called decommissioning and site restoration cost. Is this a related cost? Is this a related cost? Yes. That means, can we add a DSR cost to the cost of PP? Yes. But don't add 10 lakh. Don't add a 10 lakh because 10 lakh is today's value or future value? Future value. Find out its today's value. Find out its today's value, which we call it as what, sir? Present. For that, we use some discount factors. Leave that aside. Let's say that comes to how much? 7 lakh. Future value how much? 10 lakh. Present value how much? 7 lakh. That means you will only add how much to the cost of PP? not 10 lakh. You'll only add how much? 7 lakh. But cost is 10 lakh, no, sir. Balance 3 lakh is there, no? That goes off to P&L. As what? Interest charges. To the cost of PP, you'll only add how much today? 7 lakh. Balance 3 lakh will be booked as an interest charges. We'll have to do some accounting for this. That we call it as unwinding of leave. Not required for your thing. Final may we'll discuss. Okay, Naji? There's something around that. But this is good enough for at your level. What are the two things you need to remember? DSR cost can be add? Yes. At full value or at present value? At present. The difference between that full value and present value is the interest charges which goes off where? PN. That much I think if you remember, in my opinion, at inter level it is good enough. Got clarity over all these three costs? Yes, pakana. Move on to the next. Sir, till now we saw cost ka inclusions. What and all can be included? The next one is on exclusion. What are the costs that should be excluded? Few things we already know. I think one you already know, which is what? Refundable taxes you cannot add. Receptionist ka salary can you add or you should not add? That we call it as administrative overheads. The administrative overhead, general administrative overheads, selling and distribution overheads, refundable taxes, any unrelated cost basically you cannot add. Relocation cost, reorganization cost, any marketing cost. Let's say I am opening a factory, I am opening a mall, brand new opening. I called Shahrukh Khan to cut ribbon, or Talaivar city, so Talaivar we will use. I called Rajni sir and said, come cut a ribbon. Come cut a ribbon. Rajni sir just told Anju Koti, avalada. I could not argue with him because I know that he'll give Padayappa dialogue. Or what is Sanna? Yeah, that way. He told 5 crore, if you come means I will come and cut the ribbon. Otherwise, I will not come. I said, fine, sir, come. Okay, come cut the ribbon. Okay, how much am I paying? 5 crore. 5 crore, can I add it to the building cost? No. Because all that comes under which category? Marketing. So yes, when Rajnikant sir comes and cuts the ribbon, there is benefit. But there is a benefit only to the building or to my overall business. So this is not benefiting just the asset. It is benefiting my overall business. Hence the standard says, boss, this is not exclusively related to asset, but rather it is benefiting your whole business. Hence any sort of marketing expenditure, don't add it to the cost of PPE, but rather transfer it to P&L. What about free issue of what? Free issue of goods? That again, we are talking about PPE. Goods is an inventory, right? How will the inventory affect PPE? Right? So that will not come in again here. Okay. So when the moment asset is ready to use, capitalization stops. Okay. So that will not come into picture here. These are some cost exclusions which are called out. Move on to the next one. People. Yes, sir. Okay. Next one is subsequent recognition. So previously we discussed what? Initial recognition, which we know initially every PPE should be recorded at cost. Okay. Now we are talking about subsequent recognition. Subsequent recognition means at year ending. At reporting period ending, that usually is year ending. Some companies also follow quarterly financial statements. But anyway, instead of for the simplicity, we'll stick to this. So at every year end, how should we account PP? Initially, you will record PP at cost. At every year ending, what we should do? That is the subsequent recognition ka provision. AS10 gives you two options here. At the year ending, okay, you can follow one of the two options. One we call it as cost model, as in CM. Another one is a revaluation model called RM. Either we can follow cost model or we can follow again it went. Scable, I think I'll trust her and move forward. Okay, for you it's coming now. The moment it stops there, you tell me. Okay, so then I think yeah. Okay. Cost model or revaluation model. Those are the two models which are acceptable for this one. Cost model, you know it. You've been doing it from the time you learnt accounts. Tell me, sir, after you purchase PP, what you will do? Subsequently, you go on charging depreciation. You go on reducing depreciation and show the final value where? In balance sheet. That is nothing but cost model. After purchasing PP, if you go on reducing depreciation and show the final value in balance sheet, we say companies following what model? Cost model. Actually, impairment also should be considered here, but leave that aside. We'll take it later. Okay. Next, if companies doesn't want this one, they can go for another model called revaluation model. Revaluation model means simply to show the asset at its fair value. Let's say I purchased, our Prem Garu is still sitting here only. Luckily he came today. I thought I used his name too much and he'll bunk. No, he came. So Prem purchased Nungam building for how much value? 25 lakhs. See, kidney. You remember? I think you'll never forget that. Huh? He purchased for how much value? 25 lakhs. Today that land value is how much? 25 crore. If Prem shows that land in his books at 25 lakh, land we don't depreciate, no. If Prem shows that building or land in his books at 25 lakh, we say he is following what model? Cost model. Suppose Prem told market value is 25 crore, I want to show 25 crore in my balance sheet. Then we say he is following what model? Revaluation model. As simple as that. Okay. So revaluation model means to simply show the asset at its fair value or market value. Company has a choice. Either they can go for CM or they can go for R. Okay. But there are some criterias or there are some things you need to keep in mind for revaluation model. What is that is? Sir, selective application nahi chalega. Meaning selective application you cannot do. Meaning, sir, if you want to follow revaluation model, entire class of PPE should be revalued. Suppose so I have 3 machineries. I have how many machineries? 3 machineries. One I am using for morning shift 2. I have a factory. Morning shift mein I will use machinery number 1. Afternoon shift mein machinery number 2. Late night shift or night shift mein machinery number 3. All are identical, same. Okay, they are used for different times. 8 hours I am using so that my factory runs 24 hours in a day. Okay, Naji. Now for machinery 1, okay, I want to follow cost model. For machinery 2, I want to follow revaluation model, or 3 also, let's say I want to follow revaluation model. Acceptable or not acceptable? Because these 3 belongs to different class or same class? Same class means they are identical. If the assets are identical, then you can't do partiality. One cost to one revaluation, not acceptable. Either for all the 3 we'll have to follow cost model, for all the 3, or you have to follow revaluation model. One cost to one RMO, not acceptable. Within the same class, partiality not acceptable. That's what we mean by you'll have to do the revaluation on entire class of PP. Okay with this? Sir, suppose I have one machinery and I have one furniture. I have one machinery and I have one furniture. For machinery, I want to do cost model. For furniture, I want to do revaluation model. Is this not acceptable or acceptable? This is acceptable. Why? Sir, machinery and furniture are identical or separate? Separate. If it is separate class means partiality allowed. Meaning for one you can follow something else, other one you can follow something differently altogether. This is fine. Within the same class, partiality is not allowed. That's what we mean by this. Class means again what, sir? A group of assets which are similar, which has the same cash flow, same usage, similar, etc., etc. That becomes your one class. Okay. Sir, how often should we do the revaluation model? Because fair value will be same. If today, if market value is 25 crore, tomorrow it will be same. No, tomorrow it could be more or it could be less. That means market value changes every day, every week, every month possible. That means every month we'll go on accounting. No. So there must be some time frame or a window. What standard says is if you have a volatile PP, if value of that PP fluctuates too much, maybe case of a land or a building, then you will have to do revaluation at least yearly once. You'll have to find out the revaluation at least once. If the asset value is not changing so much, like maybe like furniture or machinery, then you can do revaluation once every 3 to 5 years. That is the window given. If it's a volatile, and question will specify whether it is volatile or not. You don't have to worry. Okay. Yeah. Still there, no? Okay. So volatile PP, at least once you have to do annually the revaluation, or other non-volatile, you can go for 3 to 5 years. Now, if you want to go for revaluation, how the accounting will look like, I've just summarized it into this chart. We have done some questions also on this, but anyway, in regular class, but now I think this example should be good enough for us to learn. Okay. Suppose company wants to do revaluation model. Okay. Let's take an example of a land. It's easy to explain with a land. Okay. Now people, first time I did a revaluation. First time I purchased the land in first year, and first year ending I want to follow what model? Revaluation model. To find a revaluation model, I need one component. What is that? Market value. So I found out the market value. Okay. Let us say I purchased the land at an original cost of 50 lakh. When I purchased the land, I paid how much, sir? 50 lakh. But at year ending May, the market value has become 55 lakh. At the year ending May, it has become 55 lakh. Sad face or a happy face? Happy face. Meaning it's a case of what? Gain. So first time I did a revaluation and I got how much gain? Oh, 5 lakh. What we have to do? Standard simply says first time when you do revaluation and if you get a gain, right? This is a realized gain or unrealized gain. Realized gain means you have got this gain. Have you got it or only bookish gain? See, you will get a gain only when you sell the land. Have you sold this land or not yet? Not yet. Because this is only what? Just market ka price value increase. I have not sold this land right now. So this is a bookish gain. So AS10 says you transfer this gain not to P&L. You don't transfer this gain to P&L. Put it in one reserve. Put it in one reserve. That is called what, sir? Revaluation reserve. Okay, G. So this 5 lakh ka gain, you will park it in one reserve called revaluation reserve. Tell me the entry for this. Let's see. Tell me the entry for this. Currently, my land is shown in my books at 50 lakh. But I want to follow what model? Revaluation model. Revaluation model means to show the asset at carrying amount or market value. Revaluation model means you want to show the asset at its market value. That means from 50 lakh, I have to bring the asset to 55. Asset has what balance? Debit balance. Now we have to increase that asset balance or reduce? Increase. Something which has debit balance, how do you increase that? Debit again. So what's the entry? Land account or PP account debit how much? 5 lakh. And you will transfer this gain to P&L or a specific reserve. Since it's unrealized gain, standard is recommending us to put it in one reserve called RR, revaluation reserve. This is the entry you will pass. Any problem? No? All okay? Macha, you are also okay, Nada? Carlito. Yeah. Yeah. Let's take the Ulta example. Let's take the Ulta example. This was what? This was a case of what, sir? Gain. Next, it could also be a case of loss. First time I did a revaluation and I could get a loss. When will I get loss? When market value has increased or market value has reduced. Let's say market value has reduced by 7 lakh. So it will be a case of first time I did a revaluation and I got what, sir? Loss. How much loss? 7 lakh. In that case, what you will do? Do you have any reserve now? In that case, standard says park it in P&L. Loss, you transfer it off to P&L. I know a little partiality, but just the way. Because Indians know accounting standard is big on still on conservatism concept. What does conservatism or prudence concept say? Loss you transfer. Gain you wait. Gain you wait till the time you get the gain. Loss you can transfer bindas. That's what conservatism says, right? So even this is also a little extension of that. So if you get a loss first time, you transfer the loss where, sir? P&L. Tell me the entry for this. Let's see. You got a loss means asset value has to be increased or reduced. Asset has debit balance. How do you reduce it? Credit PP. What will you debit? P&L. So the entry will be P&L account debit to PP. This is the entry. Either this will come or that will come. Okay, can we take one step further? So first year, I'll take this scenario. First time we did revaluation and we got a gain. How much gain? 5. First time we did revaluation and got a gain of how much? 5 lakh. This is in first year. So mine is a volatile PP. My asset is a volatile PP. Volatile PP means I should revalue only once or every year. At least once I have to do it every year. I mean second year also I should revalue. Second year again I did revaluation, but this time I got to Vastu not good. I got a loss. First year when I did revaluation I got a gain of how much? 5 lakh. Second year I am getting a loss of 8 lakh. What we have to do? Getting the scenario. This is a continuation. From here to here we are jumping. First time gain, second time loss. Okay. Now loss means where will you transfer? P&L. But hang on. Sir. Do you have any balance in RR? How much you? 5 lakh. So don't transfer entire 8 lakh loss to P&L because you have a balance in RR. So out of 8 lakh, how much loss you will adjust against RR? 5 lakh. How much is still remaining? 3 lakh. That 3 lakh only you transfer where? P&L. That's approach. So second time when you do a loss, that loss don't directly transfer it to SPL. First check whether you have balance in RR. and adjust that balance with what? RR first. Still, if there is any loss remaining, means transfer it to PL. That's a concept. Okay, G? Okay, G? Tell me the entry for this, G. Loss is 8 lakhs. So PPE you have to increase or reduce? By how much? 8 lakhs. So you will credit PPE by how much? 8 lakh. Okay, Naji? You will debit P&L by 8 lakh or first RR? RR you will debit by how much? 5 lakh. Why 5 lakh? Because balance available is 5 lakh. So here RR credit, here RR debit. It got squashed, nullified. Still loss is there. Yes. How much loss still remaining? 3 lakh. That you transfer where? P&L. That's all. It's a fund. So this is the continuation from here to here. Can we move to the next scenario? What do you think will be the next scenario? First time I did revaluation and I got a loss. Second time when I did a revaluation, I got a gain. Okay? That scenario. From here to here, wala jump. First time I got how much loss? 7 lakh. First time when you get a loss, you don't have RR. First time when you do a revaluation and get a loss, there is no RR. So where has this loss gone to? PN. Next time you have got how much gain? 9 lakh. Gain means you park it in one reserve called what? RR. But don't transfer entire 9 lakh to RR now. Why? Initially when you got a loss, you booked how much in P&L? 7 lakh. Reverse that. Reverse that. How much extent? First adjust how much with P&L? 7 lakh. Balance 2 lakh only. Gain you transfer it to RR. This is the fund. So whatever you have done before, first undo that. Do the ulta of that. And then proceed with your treatment. Okay? Tell me the entry for this. Gain. Gain of 9 lakh. Gain means PP you have to reduce or increase. How much? 9 lakh. So what is the entry? PP account debit how much? 9 lakh. To RR 9 lakh? No. How much loss you have booked in P&L? So that means you will credit P&L by how much? 7 lakh. Balance 2 lakh only to. That's a fund. Is this good enough? Okay. For depreciable asset, we do slightly differently. I think I'll not go into that for the time being. You'll learn about that in final level. Okay, there's some extra fitting you'll have to do. 2 extra methods will come. Leave that. Not required now. Okay, next. Moving on to the next one. Any doubts so far? All okay so far? But still good so far on the screen there? I don't have to show you, Christopher. No, but mine did come only. I pulled all the wires. I don't know what else to do. I'll shake it one. Shake Abdullah. No, it's not coming. Okay. Next concept is PP acquired on a deferred credit. PP acquired on deferred credit. What is this concept? Very simple. Sir, when I buy let's maybe I've taken any asset here. Okay, no asset. Let's say, sir, I purchased a furniture. Now, normally business do the transaction not on a cash basis but on a credit basis. When you do business to business transactions, usually it will be on a credit basis. Let's say furniture ka usual credit is 1 month. Usual credit is how much? 1 month. Meaning I will buy it today and make the payment within 1 month. I told the vendor I need 2 years credit. I need how many years credit? 2 years credit. Normal credit is how much? 1 month. But I am asking how many years credit? 2 months. This concept we call it as PP acquired on a deferred credit. Meaning you are taking the normal credit or more than normal? More than normal. In that case, what we'll have to do. That's all is this concept. Okay. Alright. I'll maybe take you through this example only. Sir, let's say I purchased a furniture for how much value? 12 lakh. How much credit I am asking? 2 years credit. Okay. Sir, if I purchase the same furniture under normal credit, how much is normal credit? 1 month. I have to pay just how much? 10 lakh. For 1 month credit, my purchase price is 10 lakh. Since I am delaying the payment by 2 years, the other vendor is saying, give me not 10 lakh, but give me 12 lakh. Okay. Both the points are fine with you. Now the question will arise. I should record PP in my books today at 10 lakhs or 12 lakhs. Got the concept? I should record the PP in my books today at 10 lakhs or 12 lakhs. Okay. Overall concept is good. What AS10 ka provision says is, whenever you do any transaction on a deferred credit basis, meaning not under normal credit basis, you'll have to record the PP at cash price equivalent or CPE. At what price? Cash price equivalent. That I'll tell the provision once. The difference between the total transaction price minus cash price equivalent is your time value of money ka interest charges, which goes off to P&L. So nothing understood, sir. Very, very simple. Record it under normal credit value. Record it under normal credit value. What is normal credit value? 10. So show the PPE at what value? 10. This only we call it as cash selling price, or you can also call it as cash price equivalent. Both are fine. Okay. So you will record the PPE today at what value? 10 lakh. But are you paying 10 lakh or are you paying 12 lakh? 12 lakh. How much extra are you paying? 2 lakh. Now honestly touch your heart and tell that 2 lakh what you are paying. Is it for PPE or is it for the delay? It's for the delay. Correct. Now when you take a loan and when you repay after 2 years, your bank will collect interest from you. Interest you will capitalize or goes to P&L. That's what AS10 is also saying. So the difference between these two, which is what? 2 lakh, is the interest charges, and it should go where? P&L. Do not capitalize that, but transfer it off to P&L. There's some accounting needs to be done for that. Extra CA fine. Not required. Again, that unwind. Why am I saying that? Huh? Oh, overall got it. So what is this provision once again? If you, this is a normal credit or deferred credit. In deferred credit transaction, record PP at normal credit value. The difference between the transaction price, which is 12 lakh, and the normal credit value, which is 10 lakh, whatever in this example. That difference is interest charges, which you will transfer it to P&L. That's all I've written over here. Move forward to the next. Okay, next. One or two more, and that the conceptually we are done. The standard conceptually we are done. Then based on the time, we'll see how many questions we can take up. So today also you will give break at 11:30, yes sir? No. This one and one more today I will give you a little early. You can have that, you can bring back that smile. Okay. He's saying, tell me the time. No. This one and next standard, 9:30 I will give you a break. 9:30, 9:40 max. Then he's like 10:30. We got to know, you know. He says 9:30 means 10:30. Hey, not like that. Don't be like that also much, huh? Okay. Next one is still okay. Okay, fine. I don't know much. Our screen is blank. See, I'm not kidding. See, some cable issue it seems. Hopefully, it is recording. She told you don't do that. I will do that creativity. Now I'm scared to do. Where she's like, I told you don't do. You did. What she gives me some on the head. Okay, leave that. I hope it's recording. Next concept is PP acquired on exchange. Barter system. Barter system. You know, we exchange lunch dabbas and all. No, like that business also is doing one exchange. They are giving one PP and purchasing another PP. That we call it as what, sir? Exchange. Okay. For that exchange, what we have to do? Fine. I'll tell you the provision once and then we'll take up one example maybe. Whenever, first of all, what is exchange? Exchange means what? One PP coming in, another PP going out. It need not be what is going out, need not be necessarily PP. It could be intangible asset also. But for simplicity, we will keep it as what? One PP coming in, another PP going out. That scenario we call it as exchange. Okay. Now, what AS10 says is whenever you do an exchange transactions like this, as a thumb rule, whichever PP is coming in should be recorded at fair value. Whichever PP is coming in should be recorded at fair value. Now, fair value need not be used. You don't have to use fair value only and only under two circumstances. Fair value should not be used or need not be used under two circumstances. One, when the transaction lacks commercial substance. Second one, fair value is not found outable, is not determinable. Okay. So once again, I'll tell you that provision. You don't have to remember it, but they will give you a numericals like this. If you know the provisions, I think you can handle it better is what I feel. So whenever you do exchange transaction, whichever PP is coming in will be recorded at what value? Fair value, not transaction value, not carrying amount, but what value? Fair value. But under two circumstances, fair value you need not use. What are those two circumstances? One, when the transaction lacks something called commercial substance, and second scenario you cannot find out the fair value. If one of these scenario comes out, then fair value need not be used. Otherwise, you have to compulsorily use what value? Fair value itself. Okay, so this one we understood, sir. Fair value not found outable. That's okay. Manageable. I think we made peace with that. Correct? No. What is this lacking? Commercial, blah, blah, blah. No? Transaction lacks commercial substance simply means cash flow will not change. Cash flow will, in simple terms, forget about what I've written here. Let's not go so much into detail. Okay, transaction lacking commercial substance simply means what? Cash flow will not change. Because of this exchange, neither you will get more cash flow nor you will get less cash flow. How much ever you were getting before the exchange, same cash flow you will get after exchange also. So if your cash flow does not change, then we call it as what, sir? Transaction lacking commercial substance, or transaction does not have commercial substance. Like that also you can refer. Goindana got it. Balcony also okay. There, all okay, all good. Let's take one example just to give you a little more clarity. Sir, I have one car. I gave away car and I purchased what? Machinery. I gave away car and what did I purchase? Plant and machinery. So whenever exchange transaction happens, no, it's always good to identify what is coming in, what is going out. Write it on a side of paper, man. I mean, in your answer sheet only. At the end, may just simply write in some, make one small box and write which asset is coming in, which asset is going out. Here, what is going out? Car. What is coming in? Plant and machinery. And write two details for that. Carrying amount, fair value. Carrying amount, fair value. It will be given to you in the question. Let's say the carrying amount of the car is how much? All these are assumed numbers for the sake of explanation. Fair value is how much? 11 lakh. And fair value of machinery is how much? 12 lakh. Okay, now this data will be provided to you in the question. Just have it in some corner. So it will help you to pass the entries first. Okay with the scenario? Now, go back to the provision. Is this an exchange? Yes. Right? What am I exchanging? Car I am giving away and I am purchasing plant and machinery. So one PPE is coming in, which is what? Machinery. Another PPE is going out, which is car. Now, whenever exchange transaction happens, go back to your provision. As a thumb rule, what we have to use? Fair value. As a thumb rule, we have to use fair value. Okay, Naji? Second, fair value should not be used. Fair value should not be used under one of the two circumstances. One what? Fair value is not determinable. Here you cannot find out fair value or fair value is given. So that scenario is there or it is ruled out. It is not applicable because you are able to find out fair value. Second condition says you should not be able to find fair value. That is getting applied here or not applied? Here you are finding fair value. Yes or no? So that is ruled out. What is another one? Transaction lacking commercial substance. Transaction lacking commercial substance. What did I say in simple terms? Lacking commercial substance means what? Because of this transaction, cash flow should not change. How much ever benefit you are getting from car, same benefit you should get from plant and machinery. Sir, using car, using machinery same. Using car, using machinery same, completely different. Completely different. I mean, this transaction lacks commercial substance or has commercial substance. In this transaction, my transaction is not lacking commercial substance, but rather it is having commercial substance. Correct? That means we should ignore fair value or consider only fair value. Consider only fair value. Because transaction is what again? Transaction is having commercial substance. I'll give you another example for lacking also. But so far okay? Once more or got it? Pakka. Okay. So now we have established one thing, which is what? We have to compulsorily use what? Fair value. Now second question will come into picture. Which fair value? Because this asset ka fair value 11. This asset ka fair value 12. Which one should we use? Did you understand? Because we have one asset ka fair value or two assets ka? Standard says, okay, you can use whichever assets ka fair value you can find out more clearly. Because market price is subjective, no? Right? So what standard says is you can use whichever assets ka fair value which you can find out more appropriately or clearly. But for exams, you always take this for just for the exams. You always take fair value of the asset given up. First priority, you will always take what? Fair value of the asset given up. What did we give up? Give up means asset going out. What asset is going out? Car. That means first priority will always be given to the fair value of car in this example. If this is missing, then you will take what? Plant and machinery, other asset ka fair. Did we understand this? In fact, I used to tell this as an easy remembrance. You know your house information better or your neighbors? You know your house information better or your neighbor? That depends on the neighbor, sir. If neighbor is pretty, then we will know that better. Not that way. We are not going to romantic things over here. Yes. So obviously we will know our asset ka information better. Yes or no? Which is our asset here? Car. We are using car right now. Na? So we will know the fair value of the car better. Hence for exams, first priority is always what? Fair value of the asset given. Okay. But standard gives you the liberty to use whichever. But exam use this only. Okay, Naji. Now entry. For a moment, forget about the amount. First pass the debit and credit. You know real account rule. Debit what comes in, credit what goes out. Which is coming in? Plant and machinery. Debit. Forget the amount. First complete the entry. Debit what comes in. What is coming in? Machinery. What is going out? Car. So credit car. These are okay now. Now the value. Car is going out means, can I show it in my books or cancel from my book? Cancel. Yes, sir. Sir, currently my car is shown in my books at what value? 10 lakh. If it is shown at 10 lakh, I have to cancel also for 10 lakh. That means car you credit at what value? 10 lakh. Why? Because it is a carrying amount. I have to cancel. Yes or no? So this is figured out. Done now, people. Now, what did I tell? Whichever asset is coming in should be recorded at fair value. Whichever the asset coming in should be recorded at fair value. Which asset ka fair value will you take? Our asset, the fair value of the asset given up as the first priority. Which asset did we give up? Car. What is car? Car ka fair value? 11 lakh. That means machinery will be recorded at 11 lakh. Any problem? Like this step by step you go, so you will not make any mistake there. Easy. Journal entry matching or there's a difference? How much difference? 1 lakh. Transfer it off to P&L. Gain or loss due to exchange. Here it's a case of gain. If you're crediting P&L, it's obviously case of gain. But in some example, you could also get a loss. Whether it is a gain or whether it is a loss, transfer that to P&L. That's all. Is a simple way of passing it. Easy, easy, easy. Paka, paka. This was an example of what? Transaction lacking commercial substance or having commercial substance? Having. Let's take another example. Okay. What's your name, Acha? Karthik. What's your name, da? Ashwin or Karthik? Okay. Karthik has one land. Karthik has one land. Let's call it as land A. Ashwin has another land called land B. It got allocated from the Tamil Nadu government. You know, governments allocate some sites. No? So Karthik and Ashwin purchased. Okay. Now, Karthik, it's the same dimension, same area, same thing. It's neighboring sites. Neighboring sites. Okay. Next to each other, same area, same dimension, everything same. Okay. But for some reason, Karthik likes Ashwin's site. And Ashwin likes Karthik site. Site. Stress on that. Papa, don't bring in other things and all. Last time in class when I used this example, they said substitute land with girlfriend. Ante. Yeah. All right. So stick to the subject only. Yeah. So they are exchanging a land. Right. They are different. They are having different features or same features. Same features. Okay now. But still an exchange. Now you tell me, sir, transaction has commercial substance or lacks commercial substance. Whether Karthik uses this land or probably that land, since their nature is same, cash flow also will be same. So this is an example of what? It is a lacking commercial substance. If transaction lacks commercial substance, fair value should be used or should not be used. Okay, Naji. Now again, same drama. In the sum corner, write down which asset is coming in, which asset is going out, and mention what? Carrying amount and fair value. It will be given to you in the question. Complete the entry for me first. Tell me. For this, in this scenario, what entry you will pass? Tell me. Land coming in you will debit. Land going out you will credit. Which is coming in? B. So land B account debit. Land A account credit. Yes, sir. The asset going out we need to cancel. The asset going out we need to cancel. Cancellation will be done at what amount? Carrying amount. So land A will be credited at what value? 10 lakh. Are you using fair value here or not using fair value? If you are not using fair value, you should not book any gain or loss. You should not book any gain or loss. Because honestly, touch your heart and tell, is there any gain here or no gain, no loss? Whether you use this land or whether you use that land, you will get a different benefit or same benefit. Same benefit. That means gain should be booked or it should not be booked. That means land B also you debit at 10 lakh. If you are crediting at 10 lakh, that also you debit at 10 lakh only. That way you'll neither get gain nor you'll get loss. So whenever you are not using fair value, gain or loss should be accounted or it should not be accounted. Basically, we will use in that case what amount? That's all. This is provision. Carry on. Okay. Next one. Your favorite concept. Depreciation. Depreciation. Okay. Sir, how long will you charge depreciation? How long you will charge depreciation? Over the useful life. If you're planning to use the asset for 5 years, you'll depreciate for? If you're planning to use the asset for 75 years, depreciate over 75 years. Some assets like nuclear power plant, hydro projects and all, asset can last real long also. Okay. So basically depreciation should be charged till the useful life. When will you start? From the day you, from the day asset is ready to use or put to use. I'll tell the question once again. You will start depreciation from the day asset is ready to use or put to use. Let's say my furniture, same Bengaluru to Chennai, sandalwood furniture, you remember, no? Okay, it came today. I said next month, first day, Vastu is very good. I'm a big believer in Vastu. Example. So, today my furniture came, sandalwood furniture came to my factory, but I want to open it only when? Next month, because Vastu is good. Okay. That means when is the asset ready to use? Today. But when did I put to use? Next month. So when will you charge depreciation? From today or from next month? Don't bring in your income tax funda. Income Tax Act says you have to charge depreciation from the day it is put to use. For accounts are concerned, it's always ready to use. I told you the logic of that. I'll not go into that detail here. Perfect. So you will always start the depreciation from the date PPE is ready to use. Put to use is absolutely irrelevant. Okay. I'd given you iPhone example if you remember why it is put to use. I'll not go into that now. Not much relevant. Leave that. Okay, sir. Everyone good? Next. Sir, remember this. You will charge depreciation on the asset only if two conditions holds good. You will check two parameters. You will check two parameters or two conditions. Only if they are satisfied, you will charge depreciation. One, DA should be positive. Useful life should be limited. If these two are satisfied, you will charge depreciation. Otherwise, no depreciation. What is that? DA should be positive. Useful life should be limited. DA means depreciable amount. DA simply means depreciable amount. It's very simple. Don't get freaked out. Straight line method ka formula you tell me. Straight line method of depreciation ka only numerator formula. Carrying amount minus residual value. You'll also divide by useful life. No, that is denominator. Cut it out. Numerator is what? Carrying amount minus residual value. From carrying amount, if you reduce residual value, that result figure only we call it as depreciable amount. So DA is nothing but carrying amount minus residual value. This number should be compulsorily what? Positive. Only if this is positive, depre. Otherwise, no depre. Maybe I'll have one question. I'll take you through that. What is it? Then or maybe here only we'll do off notes. Okay. Carrying amount is 10 lakh. I purchased a building. I got a good deal. I purchased it for how much? 10 lakh. I'm planning it to use it for 5 years. I feel after 5 years, its value is going to be 25 lakh. I feel that building ka value after 5 years is going to be 25 lakh because it's a sophisticated building. Okay, like everyone in like every area will have some niche buildings. No? Like in Bangalore, it is UB City buildings. You know, Malya, Shri Malya Garu. Malya has constructed one beautiful structure that we call it as UB City. Okay, UB City is quite costly in Bengaluru, especially the floor rent. I think in Bombay, it's Nariman Point. I don't know in Chennai, which area, which building is considered as full hi-fi and all? Apartment. Okay, you don't want to tell, no issues. Okay, so I purchased one building in UB City for how much value? 10 lakh. I want to use it for how many years? Just 5 years. Building I can use it for 20 years also, but I want to use it only for how many years? 5 years. Okay. After 5 years, I will sell. I'm planning to sell. After 5 years, I feel its value is going to be how much? 25 lakh. What does residual value mean? What does residual value mean? Don't say scrap value. When you say scrap value, no, you will not get the heart to write the big value. Residual value simply means when you sell the asset, how much money you will get. Residual value simply means when you sell the asset, how much money you will get. That money can be really big, that money can be really small. Usually, residual values are very small, but some asset ka residual value can be really big. Here, now check, how much am I planning to sell this building for after 5 years? 25 lakh. That means 25 lakh becomes what? Residual value. How much did I buy the asset for? 10 lakh. That means what is this? If I do this, I'll get DA. How much is DA here? Minus 15 lakh. That means depreciate. Don't depreciate. Because is this asset really depreciating or more look like appreciating? I bought it for 10 and I'm planning, I feel I can sell it for 25 lakh. That means is it really decreasing in value or increasing in value? So do not depreciate it. That's what standard says. If depreciable amount is, if you want to depreciate the asset, DA should be compulsorily what? Positive. In this example, may positive or negative. So you will charge depre or no depre? No depreciation. That's one. Once more I got it. Once more got it. Okay. Next. Second criteria is useful life should be limited. Sir, I am planning to use this building for how many years? 5. That means I will depreciate for 5. Land, how many years will you depreciate? Land, how many years will you depreciate? No depreciation. Why? Not appreciating. There is no life. Land ka value also can reduce depending on the area. Now KGF land does not have any value much now because gold and all is already extract. Yes, no. So land ka value can also reduce, but we don't charge depreciation on land because useful life is unlimited. Before you were born, after you are gone, land was there, land will be there. Correct? No. Right? So land ka life is limited or unlimited? Unlimited. If you don't know the life, we can't charge depreciation. That's the reason we don't charge depreciation on land. Okay, not because it's an appreciating asset. Land ka also, some land ka value can also depreciate depending on the circumstance and things like that. Okay, now people, so check these two parameters and accordingly depreciate. And you will start depreciation from what day? Ready to use. Done. Now which method? Straight line method, WDV method, which method I should depreciate? Which method I should select for depreciating the PPE? Standard says whichever method you want. AS10 says whichever method you want to depreciate, you depreciate. But whichever method you select should reflect the pattern of economic benefits. The method that you have chosen should reflect something. What it should reflect? Pattern of economic benefits. It's very simple, man. You depreciate the asset based on benefit ratio. In the ratio of benefit, you depreciate the asset. Suppose I bought a machinery to produce a goods. I feel I will produce the goods for 5 years and I will produce 1 lakh units every year. Okay, from that machinery, how many units will I produce? 1 lakh. How many years? 5 years. Is that production changing or same every year? Same every year, which is how much? 1 lakh. Which method of depreciation gives you the same depreciation? Straight line. So if the benefit is same every year, you go for which method? Straight line. Let's say first year I can produce 1 lakh units. Second year I can produce only 80. Third year 70. Like this, benefit is going on reducing. Which method gives the depreciation at a reducing amount? WDV method. Like this. So if the benefit is reducing every year, you go for WDV method. If benefit is same every year, you go for straight line method. So what if benefit is fluctuating? 1 year more, 1 year less, 1 year more, 1 year less. You use units of production method. In that ratio, you do it. That's all. So based on your pattern of economic benefits, you go on depreciating the asset. Okay, Naji. This is done. Sir, depreciation in the ratio of revenue is not acceptable. In sales ratio, I can't depreciate the asset. Because, sir, just because I have purchased a new version of iPad, 100 students more will come to our class. I will put a big poster in Chennai. New brand new iPad purchase. Please come to our class. You'll come. You laugh at it. Yes or no? How will you decide to come to class? Based on the location, faculty, coaching, fees. Yes, no. That means revenue, is it dependent only on PP or others also? Sales is not determined only by PP. Sales is determined by your quality of the product, price, or your marketing capability, etc., etc., etc. So hence depreciating the asset based on revenue is not the right criteria. It's not acceptable. Okay. Sir, what if benefit changes, sir? Can I change my depreciation method? Yeah. If this benefit changes, depreciation method also can be changed. Okay. So every year what the standard says is 3 things you need to check every year. 3 things you need to check every year. Is there any change in the benefit? Is there any change in the benefit? Is there any change in the residual value? Is there any change in the life? Check if there is any change in benefit, check if there is any change in residual value, or check if there is any change in life. If there is any change in these 3 parameters, depreciation also will change. And any change in them is accounted as a change in accounting estimate. It's not an accounting policy change, it is an estimate. Okay, because useful life and all is a pakka number or estimated number. Residual value is a pakka number or estimated number. So hence any change in these parameters is considered not as a change in accounting policy, but as what? Change in accounting estimate. Estimate changes are always accounted prospectively, meaning from that day onwards. Suppose residual value changed in 3rd year. Residual value changed in 3rd year. Depreciation also will change in 3rd year. 1st year, 2nd year, what you have done. Should I be bothered or not bothered? Not. That's what prospective change means. If 3rd year may, if estimate change, from 3rd year onwards, depreciation also will change. 1st year, 2nd year, what you have done, you don't have to worry about that. What is gone is gone. That way. Move on to the next stuff. Yeah. Sir, when will you stop depreciation? When will you stop depreciation? When the asset is sold. When FEB stops, what is FEB? Future economic benefit. Sir, in order to show PPE, there should be FEB. If FEB stops, asset also will continue or asset also will stop. If asset stops, depreciation also will stop. There are other criteria like finance lease and all. Leave that, it's fine. No issues. In the interest of time, I'll not go into everything there. Next is retirement of PP. So retirement means what? Permanent break? Yes, no. So sometimes what will happen is physically asset will be present. Physically asset will be present, but we are not using it. It is true in our Bangalore godown. Now I think we have, like in Bangalore, I think we have 3 floors building. Ground floor, in one of the room, we have kept so many all these benches, and some few things like mic. Physically it is present, but are we using it? That we call it as retirement of PP. Okay. So if any PP if it has taken a retirement, meaning if it is not being used, then such PP should be recorded at lower of 2 levels, carrying amount or net realizable value, whichever is. Just again, easily testable for 1 marker MCQ if at all they want to test. So if you are not using the asset, such asset should be shown either at carrying amount or net realizable value, whichever is lower, because you are not using it. No, at best what you will do, if you are not using it, at best what you will do, sell it. No, correct? No, either you will use it or you will sell it. Since you are not using it, standard says measure it at carrying amount, it's fine. Or check what is its sale value. What is its sale value? Whichever is lower, record it at that. Suppose there is 1 PP, I'm showing it at what value? 8 lakh, meaning carrying amount is 8 lakh. But if I sell it, I will only realize how much? 5 lakh. That means this asset from 8 lakh, I have to bring it down to 5. That difference is there. Transfer that 3 lakh to P&L. Disclosure is not that very important, so it's okay. Okay, people. I think questions, we don't have too much time, so I'll take just 1 or 2. Think residual value concept, you got it now? Or 1 minute, hang on, just quickly just give me the concept revision. I think if you are there, I think I'm reasonably, I can be happy with the question. Standard name? Accounting standard 10. You want me to show the components again, or is it okay we just revise it just like that? Okay, accounting standard 10 talks about property, plant and equipment. Sir, few things are excluded from PP. One is biological assets, exploration assets. Biological assets means living plants and animals. For this, there is an exception called bearer plant. Meaning for bearer plant, AS10 is applicable. For other plants and animals, not applicable. No. Now, if you want to call a component as PP, 3 definition criteria should be satisfied. Tangible asset, held for use. That usage could be either to produce goods, render a service, administrative purpose or rental purpose. And the usage should be for more than 1 year. Okay, these are the 3 conditions. But along with this 3 definition, there are 2 recognition criteria, which is FEB and cost measurement, future economic benefits and cost measurement. All the 5 criteria satisfied means PP will come in balance sheet. Otherwise, that expenditure goes off to P&L. Okay. Next, biological asset is living plants and animals. So if you want to call a component as a bearer plant, one from that plant you should get agri produce. That produce you should get it for more than 1 year. That tree you should sell regularly or only as scrap. Only as scrap. All the three satisfied, it is a bearer plant. If it is a bearer plant, AS10 applies. Okay, next. Spare parts and standby equipments. What do you do? All criteria satisfied, PPE. Otherwise, inventory. If you are replacing any parts or a major inspection, new part ka cost you will add. Old part ka carrying amount you will minus. Initially, all PPEs are recorded at cost. Cost for this are three categories. Purchase cost, or rather net purchase cost, DAC, DSR. How do you get net purchase cost? Take purchase cost, non-refundable taxes and import duty you add, rebates and trade discounts you minus. DAC means what? Directly attributable cost. They are those costs incurred to make the asset management ready. Okay, that the examples are installation, assembly, delivery, blah, blah, blah. DSR cost can we add? Yes. At full value or present value? Present value of DSR cost you add. Okay. Some cost ka exclusions. One, refundable taxes, any administrative overheads, general selling and distribution overheads, relocation cost, reorganization cost, any sort of promotional expenditure. Subsequently, how can you record PP? One of the two, cost model or revaluation model. Cost model is go on reducing depreciation. Revaluation model means to show the asset at fair value, meaning at market value. Is there some provision for that? Yes. If one asset, if you want to follow revaluation model, then entire class of PPE should be revalued. Class means a group of assets which are similar. Within the same class, partiality not allowed. Across different class, partiality is allowed. Okay, first time when you do revaluation, if you get a gain goes to revaluation reserve. First time you do revaluation and get a loss goes to P&L. First time gain, then loss. What do you do? Loss you will transfer it to P&L? No. First adjust loss with RR. Balance loss only you transfer it to P&L. First time loss, then gain. First time loss, then gain. Second time when you get a gain, entire gain to RR? No. First, whatever loss you booked earlier, reverse it. Balance gain only you transfer it to RR. If you purchase PP on a deferred credit basis, deferred means normal credit or extension. When you do extension, what do you have to do? Record PP at normal credit value. That only we call it as cash selling price or cash price equivalent. Transaction price ka, cash price ka difference is interest charges transferred to P&L. Next, if you do exchange transaction, whenever you do exchange, as a thumb rule, you have to use fair value. Fair value need not be used under two circumstances. One, transaction lacking commercial substance. Second one, fair value not determined. Okay. Alright. Simple way to pass the journal entry is first finish the entry. Asset coming in, you debit. Asset going out, you credit. Asset going out should be cancelled. Cancellation will always happen at carrying amount. The asset coming in will be recorded at fair value. Which fair value? For exams, the priority is always fair value of the asset given up. Difference you transfer it to P&L. It could be a gain or it could be a case of loss. Depre. If you want to charge depre, two criteria. Useful life, unlimited. DA should be positive. Depreciation starts from asset is ready to use. Okay. Which method of depreciation? Any method which reflects pattern of economic benefit. Basically, benefit ratio you use. Okay. Can depre method be changed? Yeah. Can useful life undergo a revision? Yes. Can residual value estimate change? Yes. Any change in these three are changes in accounting estimate. Always done prospectively. Can you depreciate based on revenue in sales ratio? Not acceptable. Any asset which has retired, what you will do? It will measure it at carrying amount or net realizable value, whichever is lower, difference to P&L. Okay, Ji. Okay, let's take one. I think I have time only for one question. I don't have time for that also, but yeah, fine. We will do this. Otherwise, you will say sapado. No, I see it. Now I'm keeping your sapado into picture and taking the number of questions. Okay, question number 18. I think this is a study material question and our class note question as well. Quickly, I'll read. Shrushti Limited, one company, they have contracted with a supplier to buy a machinery which will be installed in how many months time? 3 months time. So machinery will get, is it immediately ready or after 3 months? It will become ready to use after 3 months. Special foundations were required for the machinery which were prepared within the supply, blah, 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 they're saying. Cost of site preparation is 141,870. Sir, site preparation also is an example of DAC. Site preparation means, let's say the land is like this. So, Humpty Dumpty. That land, no, it is not leveled. It's not straight. It is little bit like this. Can I install the machinery on a land which is like this? No, what I have to do? I'll have to make it flat. That we call it as what, sir? Site preparation charges. Unless I level that land, can I install my machinery? No. For me to install the machinery and use it, are these charges necessary? Yes. So that means it becomes what, sir? Can I add this, sir? Can I add site preparation cost to my cost of PPE? Yes. We'll take. Whatever you say, we'll take. The question is this only. They will give you many cost and say, can you add or subtract or exclude, whatever. All right. These activities were supervised by a technician during the entire period who is employed for the purpose of 45,000 per month. So someone is supervising this work because the asset is not ready. It will take how many months? 3 months. So somebody is supervising this work for how many months? 3 months. Nobody will supervise at free of cost. How much are we paying them? 45,000. So that is for 1 month. How many months asset is taking? Multiply 45 threes are how much? 135 is it? 1,35,000 can we add? Yes. Because it is also an example of DAC. You don't have to call it as a DAC to DSRO and add. Simply you can add. For our clarity, we categorize them as DAC to DSR blah blah. Exam you don't have to mention it. Okay. The technician service were given by department B to department A, who billed the service at 49,500 per month. So this technician, no, we did not hire from outside. We hired from the other department. Now here, Arivu, we have CA department, CS like this, no? So one department is giving service to another department. But they are not giving the service at 45, they are giving the service as 49,500. That means how much profit they are including. The difference between these two, which is what, 4,500. Sorry, it's an internal profit, no? Profit and all can you include in the cost of PPE? Cost can be included. Profit, no. So that means will we take 45 per month or 49,500 per month? 45,000 per month. And for 3 months, it is 45,000 into 3, which is 135. So if there is any interdepartmental work going on and any profit is included, eliminate the profit. That's a takeaway. Machinery was purchased for 1 crore some amount. Purchase cost can be added. Yes, but hang on. This amount includes IGST. It includes GST at what rate? 12%. Hang on. Tax. This is a tax. What does AS10 say? Refundable taxes exclude. Non-refundable taxes you can include. That's the thing. Now we'll have to know whether the input credit for this tax is available or not available. Check what are they saying. This is the purchase price. This is the purchase price and it includes how much IGST? 12%. For which input credit is available. Sir, input credit is available means it is what? A non-refundable tax or refundable tax? It is a refundable tax. Correct. Because on one hand may you are paying, another hand may you are recovering. Pay attention here. It's okay. That Indrani madam will take care of that. Yeah. So this is what? This is what? Refundable taxes. Can we add this or exclude this? 1 second, guys. I've got something. Just management. Thank you so much. Yeah. What was I saying? Refundable taxes you should not add. And this is a case of what? Refundable tax. But check here. This price no is including GST. This price is including GST. That means GST is already included in this. Yes. So can we include this now or exclude this? Exclude. Why should we exclude again here? Because it is not a non-refundable tax, but it is what sort of a tax? Refundable tax. They have already included. We have to find it out and exclude. Let's find it out. Simple basic mathematics. Sir, if 100 rupees is the cost of the asset, how much GST you will pay? 12 rupees. Why? 12% GST. No? So 100 ka 12% if you apply, you will get 12 rupees. That means including GST, what will be the amount? 112. Got it? 100 rupees is excluding GST. 112 will be including GST. So just put up that dabba, cross multiplication. If excluding GST amount is 100 means including GST amount will be 112. That we proved it with this example. Correct? Same way, look at this example. Including GST, what is the value they've given? Including GST, what is the value they've given? Including GST, the value is 1 crore 58 lakh 34,000. If this is 112 means that is 100. If this is 1 crore 58 lakh means how much is excluding GST? Multiple ways to calculate, but you choose the proration method. So find out X. How do you find out X here? Cross multiplication. These two you multiply, this you divide. You will get how much? So 1 crore 41 lakh 37,500 is the amount excluding GST. So which one should we add? This number or this number? 158 or 141? That's all it is. If you want, you can cross check also. Take this number and add it 12% in your calculator. If you, some people know they're not comfortable with their calculations. They'll do something and they'll be wondering, did I do right or wrong, right or wrong? If you are in that category, just take this number and add 12%. Take this number and add 12%. What are you getting? Obviously, you will be getting this number. Yes, sir. That means your calculation is right. That way also you can kind of you can do that. So are we good with this? Yes. Now which number should I add it to the cost of PPE? 158 or 141? Check, have they taken 141, 37, 500. That's what they've taken. All right. Next. Transportation charges is 55,770. Transportation charges is DAC. Can you add? Yes. Added. Yes. An architect was appointed for 30,000 for supervising the installation. So this is your installation charges. Can we add? This is also an example of what? So all this you can add. So your net cost of your PPE becomes this. So initially when you pass journal entry in your books, the journal entry will be passed for 1,45,140 rupees. That's all is the intention of this question. Done, Aji? Okay, thank you for your time. Patience. Break, wait.